You fill your car with gasoline. You pay in dollars. A ship crosses the Pacific carrying crude oil to Japan. The transaction settles in dollars. A refinery in Germany purchases Saudi crude. Dollars change hands. Every single day, approximately 100 million barrels of oil trade on global markets. Every barrel prices in United States dollars. You have never questioned this. You assumed it was natural. It was not natural. It was engineered. And the engineering happened in a series of secret meetings in 1974. People think the dollar dominates global trade because America has the largest economy. The economy is a factor, but Germany has a large economy. Japan has a large economy. China now has a massive economy. None of their currencies command the oil trade. People think military strength explains dollar supremacy. The military is a tool, but the Soviet Union had a formidable military. Russia today maintains nuclear parity. Their currencies never touched the oil markets. The economy and the military were components. The real mechanism was a secret deal between Henry Kissinger and Saudi Crown Prince Fahd, a deal the United States Treasury kept classified until 2016. The dollar did not earn its position as the global reserve currency through market forces. Washington created artificial demand for dollars by controlling the one commodity every nation on earth requires: oil. This was leverage at a civilizational scale. Control the currency of energy transactions, and you control the financial oxygen supply of every industrial economy. Create a system where every nation needs dollars to power their factories, heat their homes, and move their goods. Those nations must then sell their products to Americans, or purchase American financial instruments to acquire those dollars. The extraction of global wealth becomes automatic. The concentration of financial power becomes structural. The arrangement creates permanent demand for American debt and permanent buyers for American deficits. Welcome to the history of wealth. We follow the money, trace the power, and expose the history they never taught you in school. The petrodollar system shapes your life today in ways you have never considered. When the Federal Reserve raises interest rates, it does so knowing foreign central banks hold trillions in dollar reserves they accumulated through oil transactions. When the United States runs trillion-dollar deficits, it does so knowing oil-producing nations will recycle those dollars back into Treasury securities. When Washington sanctions a nation and cuts it off from dollar clearing systems, it weaponizes infrastructure built on the 1974 agreement. Your mortgage rate, your government's borrowing costs, your nation's foreign policy constraints all flow from a handshake deal made 50 years ago in the Saudi desert. To understand how this system came to control your financial life, you need to understand the crisis forcing its creation. The Nixon shock, August 15, 1971. President Richard Nixon addressed the American public from the Oval Office. He announced the United States would no longer convert dollars to gold at the fixed rate of $35 per ounce. Economists call this moment the Nixon shock. The name understates the earthquake Nixon triggered. Since 1944, the global monetary system had operated on the Bretton Woods framework. 44 Allied nations gathered at a resort in New Hampshire during the closing years of World War II. They designed a new financial architecture. The United States, holding 3/4 of the world's monetary gold and emerging from the war with its industrial base intact, would anchor the system. The dollar would be convertible to gold at a fixed rate. Other currencies would peg to the dollar. Global trade would flow through this dollar-gold link. The system worked for 2 decades. Then it began to crack. America ran persistent trade deficits throughout the 1960s. The Vietnam War drained hundreds of billions from the Treasury. President Lyndon Johnson's Great Society programs expanded domestic spending. The Federal Reserve printed dollars to finance both guns and butter. Foreign central banks accumulated these dollars. They began to notice something troubling. The United States held approximately $10 billion in gold reserves by 1971. Foreign central banks held claims on American gold exceeding $40 billion. The math did not work. If every foreign holder demanded gold for their dollars simultaneously, the United States would default. Some nations did not wait to find out. France, under President Charles de Gaulle, began aggressively converting dollars to gold in the late 1960s. De Gaulle sent French naval vessels to New York Harbor to collect physical gold bars from the Federal Reserve Bank of New York. He publicly denounced what he called America's exorbitant privilege, the ability to pay for imports with paper currency backed by decreasing gold reserves. Other nations followed. The gold window bled. Nixon faced a choice: honor the gold commitments and watch American reserves evaporate, or close the gold window and face the consequences. He chose to close the window. The consequences arrived immediately. The dollar entered free float against other currencies. Its value dropped precipitously. Foreign nations holding dollar reserves watched their purchasing power evaporate. The global monetary system lost its anchor. Chaos spread through currency markets. Nixon had solved the immediate gold drain problem. He had created a larger problem. The dollar now had no fundamental backing. Nothing forced foreign nations to hold it. Nothing required international trade to price in dollars. The American economy depended on foreign demand for dollars. Without the gold link, Washington needed a new mechanism to create this demand. Treasury officials understood the stakes. If the dollar lost its reserve currency status, America would face the same constraints as any other nation. It would need to earn foreign currency through exports before it could import goods. The era of printing currency to pay for foreign products would end. American living standards would fall. American power would diminish. The solution required finding a commodity every nation needed, a commodity with no substitute, a commodity America could influence. Oil met every criterion. The 1973 oil crisis created the conditions for the petrodollar system. In October 1973, Egypt and Syria launched a coordinated attack on Israel during the Yom Kippur holiday. Israel faced initial setbacks. The Nixon administration organized a massive airlift of military equipment to Tel Aviv. Arab members of OPEC responded with an embargo. They cut oil production and banned exports to the United States and other nations supporting Israel. The embargo lasted 5 months. Oil prices quadrupled from $3 per barrel to $12. American consumers waited in lines, stretching for blocks to fill their tanks. Gasoline stations ran dry. The stock market plunged. The economy entered recession. The crisis demonstrated a truth American policymakers had ignored. The United States, despite its domestic oil production, depended on foreign petroleum. Industrial civilization ran on oil. Whoever controlled oil prices controlled industrial civilization. The crisis also created an opportunity. Oil-producing nations suddenly held enormous dollar surpluses. Saudi Arabia's revenues exploded from $4.3 billion in 1973 to $22.5 billion in 1974. The kingdom had more money than it could absorb domestically. Saudi Arabia had a small population and limited infrastructure. It needed to invest these petrodollars somewhere. It needed security guarantees from a superpower patron. It needed modern weapons to defend against regional rivals. The United States needed a mechanism to support dollar demand after the collapse of Bretton Woods. It needed access to reliable oil supplies. It needed to recycle the massive dollar flows now concentrating in Persian Gulf states back into the American financial system. Henry Kissinger recognized the alignment of interests. Kissinger served simultaneously as Secretary of State and National Security Advisor, an unprecedented concentration of foreign policy authority. Nixon's Watergate troubles consumed his attention, leaving Kissinger to operate with remarkable autonomy. Kissinger viewed the Middle East through the lens of great power competition. He saw the petrodollar opportunity as a chance to lock the global financial system to American dominance for generations. In December 1974, Kissinger flew to Riyadh for secret negotiations with Crown Prince Fahd. The negotiations produced a framework agreement with 4 components. First, Saudi Arabia would price all its oil exports exclusively in United States dollars. Other currencies were not acceptable. Any nation purchasing Saudi oil would need to acquire dollars first. Second, Saudi Arabia would invest its surplus oil revenues in United States Treasury securities. The kingdom would become a major financier of American government debt. Third, the Treasury Department would create a special arrangement allowing Saudi Arabia to purchase Treasury securities outside normal auction processes. These purchases would remain secret, hidden from other OPEC nations and from public disclosure requirements. Fourth, the United States would provide Saudi Arabia with military protection and access to advanced American weapon systems. Fighter jets, missile systems, naval vessels, and training programs would flow to the kingdom. The agreement addressed every party's core interests. Saudi Arabia gained security guarantees from the world's dominant military power. It gained privileged access to advanced weapons. It gained a reliable investment vehicle for its oil wealth. The United States gained guaranteed oil supplies. It gained a mechanism to finance government deficits. It gained structural support for dollar demand in global markets. The terms remained secret for 4 decades. Treasury Department records declassified in 2016 reveal the operational details of the petrodollar arrangement. The standard process for foreign governments purchasing Treasury securities involved public auctions managed by the Federal Reserve Bank of New York. These auctions published results showing purchase amounts by foreign official accounts. Market participants tracked these flows. Large purchases by any single nation would become visible. They would influence market expectations and interest rates. Saudi Arabia received a different process. Treasury officials created what internal documents called a special arrangement for the Saudi Arabian Monetary Agency. SAMA would submit purchase orders through a dedicated channel. These purchases would execute outside the normal auction schedule. Most importantly, the Treasury would aggregate Saudi holdings with other foreign official accounts in its public reporting. Saudi Arabia's individual position would remain invisible. The declassified documents show Treasury correspondence addressing Saudi concerns about secrecy. SAMA officials worried other OPEC nations would demand similar arrangements if they learned of the Saudi deal. They worried public knowledge would create domestic political problems, with Arab populations questioning why their governments financed American debt rather than domestic development. Treasury officials provided written assurances of confidentiality. The arrangement worked exactly as designed. Saudi Arabia's Treasury holdings grew from approximately $500 million in 1973 to over $25 billion by 1980. The kingdom became one of the largest foreign creditors of the American government. Yet public reporting showed only aggregate figures for foreign official holdings. Economists and market analysts had no visibility into Saudi Arabia's specific position. The flow remained hidden. National Security Council documents from this period reveal the strategic thinking behind the arrangement. Memorandum NSDM 292, issued in June 1974, outlined the recycling concept. The memorandum acknowledged the massive wealth transfer from oil-consuming nations to producing nations following the price increases. It framed the recycling of these funds into American financial instruments as essential to preventing global monetary disruption. The memorandum addressed concerns about the arrangement's sustainability. Some officials questioned whether Saudi Arabia would maintain dollar loyalty if American foreign policy shifted. Others worried about the concentration of American debt in foreign hands. Kissinger's response, preserved in meeting minutes, dismissed these concerns. He argued the mutual dependencies created by the arrangement would lock both parties into continued cooperation. Saudi Arabia needed American military protection. The United States needed Saudi dollar recycling. Neither party could exit without severe costs. Kissinger proved correct for the next 50 years. The arrangement expanded beyond Saudi Arabia. Other Persian Gulf states adopted similar practices. Kuwait, the United Arab Emirates, and Qatar began pricing oil in dollars and recycling revenues into Treasury securities. The system became self-reinforcing. As more oil traded in dollars, more nations needed dollar reserves. As dollar reserves grew, more nations purchased Treasury securities. As Treasury purchases grew, the United States gained more capacity to run deficits without currency collapse. Federal Reserve records from the 1974 to 1980 period document internal debates about petrodollar flows. Some governors worried the flows were masking fundamental problems in the American economy. The balance of payments showed persistent deficits. American manufacturing faced increasing foreign competition. Inflation ran at double-digit rates. Under normal circumstances, these conditions would force dollar depreciation and economic adjustment. Petrodollar flows prevented this adjustment. Foreign central banks accumulated dollars to purchase oil. They invested these dollars in Treasury securities. This created artificial demand for dollars independent of American economic performance. The dollar remained stronger than fundamentals warranted. American consumers continued purchasing foreign goods with overvalued currency. The trade deficit widened. But the recycling mechanism financed the deficit automatically. The imbalances grew without consequence. One Federal Reserve governor noted in a 1976 internal memorandum that petrodollar flows had created a system where we export paper and import goods. He warned this arrangement could not last indefinitely. Eventually, foreign holders would question the value of accumulated dollar claims. When that questioning began, the adjustment would prove severe. That warning remains relevant today. The petrodollar arrangement succeeded beyond its architect's expectations. By 1975, every OPEC nation priced oil exports in dollars. The cartel formalized this practice at the Vienna Summit of March 1975. Public statements framed dollar pricing as a practical measure to reduce transaction costs and currency volatility. Internal communications, later obtained by researchers, reveal the American pressure behind the decision. State Department officials had visited each OPEC capital in the preceding months. They linked weapons sales, diplomatic support, and security guarantees to dollar pricing commitments. The system generated enormous flows. Oil revenues for OPEC nations grew from $23 billion in 1972 to $140 billion in 1977. A substantial portion of these funds flowed back to the United States. Some went directly to Treasury securities. Others went to American banks as deposits. Others funded purchases of American goods and services. The recycling mechanism operated through multiple channels. But the destination remained constant. Dollars left America to purchase oil. Dollars returned to America as investment and demand. American banks became key intermediaries. Citibank, Chase Manhattan, and Bank of America established dedicated petrodollar operations. They competed aggressively for deposits from Arab central banks and sovereign wealth funds. These deposits provided cheap funding for lending operations. The banks recycled petrodollars into loans throughout the developing world. This recycling created new problems. Latin American nations borrowed heavily from American banks flush with petrodollar deposits. Mexico, Brazil, Argentina, and others accumulated massive dollar-denominated debts. They used these loans to finance development projects and cover budget deficits. The loans carried variable interest rates tied to American monetary policy. When the Federal Reserve raised rates dramatically in 1979 to combat inflation, debt service costs exploded. Mexico defaulted in 1982. The Latin American debt crisis began. The crisis revealed a structural feature of the petrodollar system. It concentrated risk in dollar-denominated instruments while spreading benefits to American creditors. Developing nations bore the currency risk of dollar borrowing. American banks collected interest payments. When defaults occurred, the International Monetary Fund organized bailouts protecting American bank balance sheets. Developing nation populations absorbed austerity programs. The system also generated geopolitical dependencies. Saudi Arabia's security arrangement with the United States deepened throughout the 1980s. The kingdom became the largest purchaser of American weapons. It hosted American military personnel and intelligence operations. It coordinated oil production decisions with Washington's strategic interests. During the 1980s oil glut, Saudi Arabia increased production to drive down prices. This decision devastated the Soviet Union's hard currency earnings, contributing to its economic collapse. The petroleum economist Ibrahim Owais coined the term petrodollar in 1973. He observed the circular flow the system created. Oil-consuming nations purchased dollars on foreign exchange markets. They used these dollars to buy oil. Oil-producing nations deposited these dollars in American banks or purchased Treasury securities. American banks lent these deposits to other nations, which used the loans to purchase American goods or more oil. The cycle repeated continuously. Owais noted the system's bias toward the United States. America could run persistent deficits because the recycling mechanism guaranteed foreign demand for dollar assets. Other nations faced constraints America avoided. They needed to earn dollars through exports before they could purchase oil. America simply printed them. Congressional Research Service reports trace these dynamics throughout the following decades. A 1979 CRS report calculated petrodollar recycling financed approximately 30% of the American current account deficit. A 1991 report noted the system had enabled American deficit spending for 2 decades without the currency crises other deficit nations experienced. A 2006 report observed sovereign wealth funds in oil-producing states had become systemically important holders of American financial assets. Government Accountability Office audits documented the Treasury's special treatment of Saudi holdings. Audit reports noted the unprecedented secrecy provisions. They questioned whether existing disclosure frameworks adequately informed Congress and the public about foreign ownership of American debt. Treasury officials defended the arrangements as essential to maintaining foreign confidence in American securities markets. The secrecy persisted until Bloomberg News filed Freedom of Information Act requests in 2016. The declassified documents confirmed what researchers had long suspected. The petrodollar system operated through explicit agreements, not market forces. American dominance in global finance rested on political arrangements, not economic inevitability. The petrodollar system shapes your daily economic life through mechanisms you have never seen. Start with interest rates. The Federal Reserve sets benchmark interest rates influencing mortgages, car loans, business lending, and credit cards. The Fed makes these decisions while monitoring foreign demand for Treasury securities. If foreign central banks reduce Treasury purchases, interest rates rise to attract buyers. Petrodollar recycling provides a baseline of foreign demand, allowing lower rates than the market would otherwise set. Your mortgage payment reflects this dynamic. Foreign central banks hold approximately $7 trillion in U.S. Treasury securities. Oil-producing nations and their sovereign wealth funds account for a significant portion. Saudi Arabia's declared holdings exceed $100 billion. Actual holdings, including positions routed through offshore financial centers, likely far exceed declared amounts. These holdings create what economists call captive demand. Oil-producing nations accumulate dollars through oil sales. They recycle these dollars into treasuries. This demand allows the American government to borrow at rates lower than its fiscal position would otherwise command. Your tax burden connects to this system. The federal government runs annual deficits exceeding $1 trillion. It finances these deficits by selling Treasury securities to domestic and foreign buyers. Foreign petrodollar recycling absorbs a portion of this debt. Without this absorption, interest rates would rise. The government would face pressure to reduce deficits through spending cuts or tax increases. The petrodollar system delays this reckoning. The dollar's reserve currency status generates what economists estimate at between $50 and $100 billion in annual benefits to the American economy. These benefits include lower borrowing costs for government and corporations. They include the ability to pay for imports in domestic currency. They include employment in financial services concentrated in New York. They include seigniorage, the profit government earns from issuing currency others choose to hold. You receive a fraction of these benefits through lower consumer prices and expanded credit availability. The system also shapes American foreign policy in ways affecting your security. The United States maintains military commitments throughout the Persian Gulf. Aircraft carrier groups patrol these waters. Military bases dot the region, from Kuwait to Bahrain to Qatar. These deployments cost tens of billions annually. They create entanglements, drawing America into regional conflicts. The 1991 Gulf War to liberate Kuwait reflected these commitments. The 2003 Iraq invasion occurred within this strategic context. Ongoing tensions with Iran connect to competition for regional dominance. These military commitments serve multiple purposes. They protect oil shipping lanes through the Strait of Hormuz. They reassure allies of American reliability. They deter regional powers from threatening oil production. They also enforce the petrodollar system. Any nation considering a shift away from dollar oil pricing faces the implicit threat of American displeasure backed by regional military presence. Iraq tested this system in 2000. Saddam Hussein announced Iraq would price oil exports in euros rather than dollars. The announcement received little attention in mainstream media. Currency traders noticed. Strategic analysts noticed. Iraq maintained euro pricing until the 2003 American invasion. One of the first actions of the post-invasion administration was returning Iraqi oil sales to dollar denomination. Correlation is not causation. Multiple factors drove the Iraq invasion, but the currency dimension registered in policy circles. Libya tested the system in 2011. Muammar Gaddafi proposed a gold-backed African currency for oil transactions. He sought to organize African and Arab nations around an alternative to dollar pricing. Gaddafi fell from power following a NATO military intervention. The new government returned Libyan oil sales to conventional dollar channels. Again, multiple factors explain events in Libya. The currency dimension registered. Iran tests the system today. Iran prices oil exports to major customers in currencies other than dollars. It accepts yuan from China. It accepts rupees from India. It operates outside the dollar system America built. Iran faces comprehensive American sanctions. These sanctions cite nuclear concerns and regional destabilization. They also enforce dollar dominance by cutting Iran off from dollar clearing systems. You experience the sanctions dimension of petrodollar enforcement through prices and policies. When the United States sanctions a nation, it typically restricts access to dollar clearing. International dollar transactions settle through American correspondent banks. These banks face legal obligations to enforce sanctions. A foreign company conducting dollar business with a sanctioned entity risks losing access to American financial infrastructure. This threat proves effective because the petrodollar system made dollar clearing essential to global commerce. European companies wanted to maintain business with Iran following the 2015 nuclear agreement. American withdrawal from the agreement in 2018 reimposed sanctions. European companies faced a choice: maintain minor Iranian business and lose access to American markets and dollar clearing, or abandon Iranian business to preserve American relationships. Every major European corporation chose America. The petrodollar infrastructure gave Washington coercive capacity, exceeding its direct economic relationships. The petrodollar system now faces unprecedented challenges. Saudi Arabia has started accepting yuan for oil sales to China. In March 2023, Saudi Aramco finalized a deal allowing Chinese refineries to pay in yuan. While the volume is small, the symbolism is significant. For 50 years, Saudi Arabia priced oil exclusively in dollars, underpinning its American alliance. Accepting alternatives signals a flexibility never seen before. China has spent 2 decades preparing to challenge dollar dominance. The yuan's share of global trade settlements rose from near zero to about 4%. China created the cross-border interbank payment system as an alternative to SWIFT, signed currency swap agreements with dozens of central banks, and built the world's largest gold reserves, laying the groundwork for potential alternatives to the dollar. BRICS nations explore shared currency arrangements. Brazil, Russia, India, China, and South Africa account for 40% of the global population and about 25% of global economic output. Recent summits have discussed payment systems bypassing the dollar. Russia and China now trade mostly in their own currencies, and India pays for Russian oil in rupees. The dollar share of BRICS reserves is declining. These moves respond to U.S. sanctions. Since 2014, America has expanded financial sanctions, from Russia after Crimea to Iran, and most dramatically after the 2022 Ukraine invasion, freezing around $300 billion of Russian reserves. Other nations notice the risks of holding dollars in American institutions. Diversifying reserves becomes a rational response. The Federal Reserve monitors these trends closely. Its internal analysis notes that U.S. deficit spending relies on foreign demand for dollars and treasuries. Reduced demand could raise interest rates and undermine America's exorbitant privilege. Publicly, Fed officials downplay concerns, citing the dollar's liquidity, the depth of treasury markets, and institutional stability, but these reflect present conditions, not future trajectories. Dollar dominance is eroding gradually. 20 years ago, the dollar was 71% of global reserves. Today, 58%. Oil increasingly trades in yuan, rupees, and other currencies. Major economies are building infrastructure to avoid dollar jurisdiction. The petrodollar system created its own challenge. By supporting U.S. deficits, it shifted manufacturing abroad, empowering China, weaponizing the dollar through sanctions. exposed dependency risks, prompting other nations to develop alternatives. U.S. Middle Eastern military commitments also fueled resentments, strengthening competitors' partnerships. Saudi Arabia's strategic calculations are shifting. Domestic pressure to diversify away from oil is growing. Vision 2030 emphasizes new industries and regional hub ambitions. China offers investments in technology without American-style human rights pressure. A generational leadership change reduces personal loyalty to the U.S. alliance. U.S. shale production has weakened the original bargain. America now produces more oil than it imports, making Gulf military commitments politically harder to justify. The rationale underpinning the petrodollar is evolving. Change will be gradual. The dollar still offers unmatched market depth, legal infrastructure, and network effects. Yet each decline in dollar reserve holdings, roughly $120 billion per percentage point, each WAN-based oil contract, and each BRICS payment system adoption slowly weakens dollar demand and U.S. financial leverage. The petrodollar system structured global finance for generations. It shapes mortgages, deficit spending, military commitments, and foreign policy. Its origins lie in Nixon, his 1971, gold shock, and Kissinger, his 1974, agreement with Saudi Arabia, not in natural market forces. Understanding this history allows you to interpret current events. Saudi-Chinese deals, BRICS declarations, U.S. sanctions, and Fed policy all connect to the petrodollar system. Its continuation is not guaranteed. Political arrangements that created it are shifting. Dollar dominance was not purely economic. It was engineered in the Saudi desert. The petrodollar system was prologue, not history. Its challenges will reshape the global financial landscape and your future. The official story credits American economic strength. The money trail reveals political engineering, constant maintenance, and strategic coercion. The official story is the first lie. The money trail is the first truth.